Hey everybody, this is Lance from ThetaTraderz.com. This video I'm going to go over IV Crush, how to take advantage of IV Crush based on earnings reports, and an example that we just did at ThetaTraderz. Let's get right to it. What is IV Crush, why it happens, and how it can impact your trades. IV Crush is having to do with implied volatility. Now, implied volatility, or IV, reflects the market's forecast on a stock's potential price movement. Obviously, we don't know what the price movement will be in the future, but it's showing the potential based on probabilities. If you have a higher implied volatility, there's going to be higher option premiums, and that's because there's more uncertainty about where the stock will be. It could either go up a lot or down a lot. If you want to consider a pharmaceutical company that is about to show FDA approval or non-approval, there's going to be a wide range of possible strike prices and stocks. If you look at a very less volatile stock, like Coca-Cola, for instance, typically doesn't move a ton, there'll be less implied volatility in Coca-Cola, more implied volatility on the pharmaceutical company. This is a key input in option pricing models like the Black-Scholes. When there's more uncertainty, the premiums will go up. Now, what's IV Crush? IV Crush is a sudden drop in the implied volatility. So if you're starting with a lot of implied volatility, then afterwards there's a lot less implied volatility. That is called IV Crush. Ideally, when we're selling options, you want to sell premium at a higher price and then buy it back at a lower price, or even let it expire worthless. And this is how you can take advantage of IV Crush. This typically occurs after a major event. Earnings reports, which I did a trade on yesterday and I'll go over it. FDA decisions, product launches. We don't know exactly how well the product will launch, so that's why there's more uncertainty in how the company will do, and that'll make implied volatility higher. After the product launches, for instance, we'll know more about the company, how it's actually going, and then the implied volatility will have a sudden drop from it. In this case, the premiums will be decreased. IV and premiums before an event like that means it's a high implied volatility. IV and premiums that are after that event will have a low implied volatility. Again, we want to be selling with more implied volatility, buying it back for lower implied volatility when we're selling options. Now, the underlying stock might move very little, but the option value will still drop, and this is an example I just did. Yesterday, I took a trade on Dell. The earnings were coming after close yesterday. It was a 6:20 expiration. I sold a 95 put, bought a 90 put, so this makes it a put credit spread. And I said to take in at least $35 or more for my members. I got $39 on the trade. And I put a stop at 1.2 and an alert price at 100. If it got down to the 100, it was at 113 at the time. If I got it at 100, I'd probably just get out of the trade at that point. The delta was 0.1. And this is the screenshot this morning. Same exact option. You can see it's between 0.06 and 0.15. Let's say we could close it somewhere in the middle, maybe around 0.1 or so. It would be from 0.39 to around 1. Looking at Dell right now, it is up 0.6%. So it didn't have a dramatic up or down move after the earnings report, but the implied volatility dropped significantly because if you normally did this trade without earnings, it wouldn't have been down to 0.1 from 0.39 in one day. So leading up to big events, there's more uncertainty and IV increases. Once that event occurs, like Dell had their earnings report, and it was slightly negative in the current earnings, but the future outlook, they were saying it's a little bit more positive than what they expected. So that's why the stock is pretty much flat. Then IV will drop. And this crushes the premium value in the options, especially for buyers. If you bought that option, you'll be down quite a bit just because the stock didn't move much and the implied volatility decreased. So some ways to trade IV Crush. You could sell options before earnings. That's where you get a high premium when you're selling the option. Like I did in Dell, I was able to get about $39 per $500 in margin. It's a pretty high premium that you could get. And then use spreads to define your risk. I wouldn't necessarily sell a naked put or a cash secured put in this case, just because if it did drop a lot, then I could get assigned and it'll be hard to actually manage and wheel it out. So that's why I recommend for earnings reports to do define risk spreads like iron condors or credit spreads. If I did a call credit spread with this to make it an iron condor, that also would have worked well because the stock didn't move much. So again, if you have any questions on IV Crush, let me know in the comments down below. Like, subscribe, all that good stuff. Appreciate your support, and I'll see you guys on the next one.